Now we are looking at engineering and some other products. If we look at engineering insurance, we can divide it into two parts, projects and operationals. Now what is the difference? When we talk of projects, we are looking at machines or construction. So projects involve constructions, of buildings and roads, others, installation and erection of machines, and any losses which occur in the process of doing these jobs. What is unique about this engineering projects insurance? The value for the entire completed project must be taken from the beginning. So we cannot have a sum insured being raised in the course of the year or as the project develops. It has to be for the full value at the beginning. So what is the beginning? The normal beginning is the day on which the first material arrives at the site where the construction or erection would be done, or it would be from the time the items leave the manufacturer's site, the transit insurance, then bringing to the site, the installation and testing. So normally the insurance period in engineering projects insurance would be long term. In general insurance, we find that most times policies are annual. So an annual policy only is available in general insurance because rating depends on that, which we will see in our rating subject. So in the present setup, in an engineering project, when you are taking the full value, we are looking at the risk on a day-to-day basis, and the premium rates are worked out in that manner. So in an engineering project, the entire duration may be more than a year. Now, for example, if I am constructing a dam cannot be built in a year's time. It may take 2 years, 3 years, 4 years, depending on the nature of the territory and where it is being installed. So that period of 5 years is the insurance period. So when the insurance is taken, we will mention that the project is estimated time would be 5 years or 3 years as the case may be. So what has happened, the advantage is because the policy is going to run for more than a year, the premium can be paid in quarterly installments in a particular fashion. So quarterly installments are allowed in project insurances because the projects will be running for more than 1 year at any point of time. The second features now, when we look at projects, we have seen some of the features. Now what are the types of policies that we will find in engineering insurance? So the first policy is contractors all risk, or CAR. So when we in insurance company talk of car insurance, we are not meaning cars, motor vehicles, we are meaning contractors all risk insurance. So as you come into the insurance department, you have to be aware that car means contractors all risk. If you are wanting to insure your motor vehicles, you will say motor insurance. So what is the civil engineering works that we look at? Buildings, whether residential, factories, offices, whether roads, whether dams, whether bridges, all these come under contractors all risk insurance. So here we'll find that this is a very comprehensive insurance covering any types of losses while the project work is going on, except for what is excluded. So there will be certain standard exclusions, like we have seen in fire insurance. We looked at in more detail where we saw war and nuclear risks, misdescriptions or deliberate acts. So these would be some of the covers that would not be there. These are exclusions, but otherwise it's a very comprehensive cover because at a project site we do not know what types of losses can occur. But we have to remember, because it is construction, design defects. So if the design of the project is not proper and a loss takes place, that would not be covered. So the architects who design these projects must make sure that the design is proper so that damages may not occur. Now, an examples of contractors all risk projects, the Delhi Metro Hyderabad flyovers, and all of you have heard of accidents taking place at those sites. So those types of accidents can occur because of negligence. Workers are negligent in placing and something goes wrong. So negligent acts are covered unless it is deliberately done, it would not be covered. So each circumstance will decide whether the policy covers that risk or not. Erection all risk. When we talk of erection all risk, we are now looking at installation of a machine. So when a machine is installed, that means the machine has come to site. It is now being installed in the particular location designed for it. So installation of the machine, while the machine is being installed, something can go wrong. After it is installed, there will be a testing done, because until it is tested, we do not know whether it will function or not. So testing of the machine is essential, and only after the testing is done. So there are two types of testing. One is called cold testing and one is called hot testing. Cold testing is the machine is installed and just run. This hot testing is when it is run with a full load of whatever it has to perform. With its maximum load, it will be tested to see that nothing is wrong. At that time, if anything gets damaged, that is all part of the erection all risk. Marine cum erection. So as very word, when we see marine, whenever you hear the marine, you must remember it is involving a shipment. A shipment of a machine from a particular location, from warehouse of the manufacturer or from a particular location of suppliers to the site where it is going to be installed. So we are now looking at during the shipment of the machine, during its transit by road, rail or whatever ship, as it is coming to the site. Then after it arrives at site, it's unloaded, it is stored there till everything is ready, and then it is erected. So marine cum erection is a little further than an erection all risk. Shipment and installation. So it can happen that the machine has not come in one single machine, has not come at one single consignment. It has been dismantled or it is coming in parts, and the parts will have to be installed, fixed together and installed. So the machine cannot be erected until all the parts reach the site, which means there will be storage at that location, and storage protection also is there. It could have, while the storage is taking place, there could be a loss, damage, varieties of loss. What are the types of loss? We saw fire insurance. So most of the perils, all the perils that were in the fire policy is covered there. All the perils that we will see now in this miscellaneous will also be seen to be covered. So many number of perils and losses. We do not specify the perils in these policies because it is what is called all risk. The minute you hear the word all risk, remember, it means everything other than what is excluded under the policy. So any all risk policy, the exclusions are very important. Now, while these machines have to be installed, you need tools for doing the job. So these tools are called contractors, plant and equipment, or CPM. So CPM are equipments used for construction projects. It could be simple things like digging machines. It could be diesel generator sets. It could be concrete mixers. It could be boring machines. It could be tools for tightening and other tackling are all there. So even lifting equipments will be falling under CPM. What are CPM equipments? These are full-fledged equipments which will be used for the erection or construction of any prop. Go to any construction site, look at all those equipments there. What is the first thing you will see? Cranes. So cranes are CPM. Another thing you will see, mixing of concrete, cement mixers. You will see a DG set because the diesel generator set is required to run all those motors that are required. Then there will be pumping and borings. So all of these are equipments which are part of which can be insured along with the projects. Now when we look at the last advance loss of profit in a project. So a client, what we are seeing in advance loss, the impact due to delay. Take an example that a factory is being built, a textile factory is being set up. The buildings have been constructed and now the machines are coming and are being installed. Unfortunately, there is a severe cyclone and the cyclone causes damage to that site. Because of the heavy winds and rain, water, the cement and other materials, it has been waterlogged and the equipments are damaged. So a client who has planned that the factory would be built by X date now finds that the X date has to be extended to X plus 12 months, which means there's going to be delay of further 12 months. What is the implication for this person? So the investor and the manufacturer, the person who is setting up the factory, what is his implication? He has taken loans to build up this factory. Now where he thought that it will start functioning and revenue generation would occur and he can repay the loan quickly, he now finds that it will take another 12 months before he can start production, and so he will have to continue to pay interest on those loans. And because of the delay, it could happen that the original agreement on the loan interest rates have gone up and he has to pay a higher interest rate. So the implication for him is higher financial cost. So by taking an advance loss of profit along with the project, it is a separate policy but it is given concurrently with the project. The customer can then have insurance to take care of this kind of impact. So once the project is completed, the insurance company will look at the entire project, the times that there were insured losses and what was the delay, and worked out the financial implication, and this would be then, that loss would be payable to the customer. So this is a very technical term. In fact, we have seen in fire insurance, we talked in general, fire loss of profit. So similarly, fire loss of profit is also on similar lines. That because of a fire, the factory has come to a standstill, production has stopped. It could happen that the company is able to look at some other alternative source to do some more production, but that involves additional cost to them because they have had to take rental accommodation and other places. They have had to take machines on rent just to ensure that the production continues to some extent, because they don't want to lose customers. So these are all the loss of profits, or what we normally used to call consequential losses. It is impact of on the gross profit of a company, the financial impact of the company because of losses that are covered under an insurance policy. So this briefly was something about engineering insurance on projects. Now, once the machines are erected and completed, then the next type of policy we will look at is running machines, what could go wrong. We have seen fire insurance policy. Fire insurance said fire and certain perils, damage to all the property lying in that area, on that location, being damaged because of that. But we saw one exclusion, and that was electrical faults not covered. So a short circuit in a machine is not covered, but because of the short circuit, subsequent fire takes place, all the items that are damaged by the fire would be covered, except the equipment from where the short circuit originated. We also saw that boilers, explosion of commercial boilers, implosion of commercial boilers was an exclusion. So, can that be covered? That is also available. So these covers you will find now in the engineering operational policies. So an engineering insurance operations policies, what are the features? The machine is installed, it has been tested, it is found ready for normal operations. So the day the normal operations start, that machine can be insured for various types of risk. We have insured it previously under project insurance and erection all risk. Now we can look at insuring it under another type of insurance. But what is unique about engineering insurance? The value for which you insure has to be for new replacement value. it cannot be on market value. We saw market value yesterday, where we said market value means new value of the property less depreciation for age of the vehicle or age of the property. An example that we normally look at market value is, all of you who are fond of cricket, you know when the ball goes out of shape, what happens? A new ball is not brought. The umpire, they will come with a basket of balls from which you have to choose one which is already used. So all those balls that are brought forward are ones which are already used, of approximately so many overs already bowled with them. So what is in insurance? We are indemnity. We are putting you in same position. So insurance is normally indemnity policy. So indemnity means giving the same type. So market value policy is giving you a similar type, not a better type. In engineering insurance, the sum insured is on new value. Why? Because it is very rare that a machine will be totally damaged in the event of a peril. What usually happens is some parts are damaged and those have to be replaced or repaired. So you will not be repairing the whole machine. You will be repairing those parts that need to be repaired. Some may be repaired, a few parts may be replaced. So all the replacement will be done at new value. You can't use old parts to repair a machine. That the machine may not work after that. So for this reason, in engineering insurance, a very specific condition, it must always be new replacement value for which you take the insurance. The third important feature of operation policy is it is an annual policy like all general insurance policies. Unlike project where we had a long-term policies, here it has to be an annual policy renewed every year on the basis of revisions in values and equipment. The third feature, unlike in fire policy where we just gave a generic description of the property, as we saw, B, building, M, plant and machinery, A, other assets. Here we will have to list out each equipment, its make, model, serial number, capacity, value, year, all these are to be given, and all the parts that are part of it has to be given. And this is important because it is fully erected value that you have to insure. So what are these engineering insurance policies? First is, most common, machinery breakdown. Here what has happened? Electrical or mechanical equipments in any premises may have a mechanical or electrical fault which causes a damage to the machine and it stops functioning. Not normal wear and tear, not normal what are replaceable parts, because there are certain parts with limited life which have to be changed. So not those, but a sudden event which causes a mechanical or electrical fault, like an electrical fire or short circuit, a mechanical fault where a part of a machine breaks and so it is damaged. So these can be covered under machinery breakdown policy. A boiler insurance policy, it is covering the boiler and all the tubes attached to the boilers for the purpose of explosion and implosion. So when we say explosion, that if you understood, it explodes and it bursts open. An implosion is within the boiler, it goes out of shape because inside it collapses. So what they call boiler collapse. So both of these can be covered. To give you an example, just look at it. If any of you have seen a milk cooker, you have to fill water in the part, the milk is in the center, and there is a small outlet from which you have to pour in water so that there is a water in between, in the vacuum between the milk and the outer end. Now if the water dries up in that milk cooker while you're boiling it, what will happen? The milk cooker may explode out, which means all the milk will flow out, or it could collapse inside and become a shapeless, twisted shape. So this similar type of loss is what is covered under boiler insurance. A milk cooker was a simple example, so you can understand that. Then we can give a loss of profits for machinery breakdown or for boiler insurance. Because the machinery has failed, there is production comes to a standstill, or there is a reduction in production. Similarly, boiler has exploded and so there has been a reduction in production. These all can be covered. Impact of financial impact can be covered under loss of profits for these. Deterioration of stocks. Today the government is talking about refrigerated systems for vegetables and fruits. Why we need? Because now vegetables have to be taken across the country because markets are far away from the growing areas. So refrigerated systems will be in place. So cold storages store vegetables and fruits and foodstuffs to ensure that they are at standard temperature and they can be kept for longer period of time. So this deterioration of stocks policy is covering if because of breakdowns of the refrigerated systems, the stocks that are lying inside will deteriorate, will get spoiled. To cover them, this insurance can be taken for refrigerated systems. Now here it's a very unique and important thing we have to remember, that machinery breakdown, boiler insurance, loss of profits of machinery breakdown or boiler and deterioration of stocks have one important condition, that all of these properties must have a concurrent running fire insurance cover. So they must be insured under fire insurance, then only these policies may be taken. So no insurance company would like to give a machinery breakdown policy for machines which are not insured for fire insurance. So fire insurance perils those would be covered under the fire policy, breakdown gets covered under machinery, breakdown, explosion gets covered under boiler. So it is very important to ensure that when engineering policies are to be taken, that the existing fire insurance policy covering the property is also there. It is not necessary it should be with the same insurance company, but it must be running at the time you propose or your clients propose for these insurances. The next policy is electronic equipment. Now this is a comprehensive policy. What we mean by comprehensive? It covers all the risks that are covered under fire insurance. It covers breakdowns, so mechanical and electrical faults, and it is issued to equipments which are computerized. So electronic equipments can be insured under this policy. So it is a comprehensive policy, which means that nobody else need bother. We need not worry if no fire is there because it is all inclusive policy. So this briefly was our engineering insurance policies overview. We now go to the other policies that you will find in miscellaneous. A common policy is that most commercial organizations would be taking. The first is the burglary insurance. Burglary insurance means theft or stealing of property from a premises which we have insured. Properties that are covered under the burglary policy normally would be movable properties. It involves this, when we say theft, we are talking of not a simple theft. A burglary means with force someone has entered and taken away the property. They have either broken windows, they have broken doors, they have used knives, or they have threatened the watchman and entered. These are all terms as use of force to enter and take away property. So burglary insurance can be taken for all types of goods at particular locations. Now in burglary policy, you can insure the full value. It is called standard policy. There could be a first loss policy. When insurance companies, we talk of first loss, we mean that the total value of the goods or the nature of the goods, they are so vast that it may not be possible for somebody to burgle all the property. So we look at a percentage that is possible where the burglary could take place without knowledge. maybe 3 truckloads or 4 truckloads, depending on the area, and insure that percentage of the property. So first loss means you declare the full value at the risk and a percentage of it is being insured as percentage. Normally the minimum percent that insurance companies look at would be 10%. It can go up to 50, 60, and based on that premium gets charged. All risk policy is normally issued for valuables. So jewelry and valuables, paintings and works of art, where you have to give an itemized list of the property based on which insurance will be given. Baggage insurance, the minute you hear baggage, we are now talking of somebody traveling. It may be a business trip, it may be a holiday trip. So what you take with your baggage normally are personal effects. So personal effects, clothing and other things, personal toiletries can be insured. If your money is normally not insurable, jewelry and other valuable items will have to be specified for the insurance to be given. So baggage insurance is when you are traveling for the duration of your travel. It could be within the country or outside, all over the world. The next product is money insurance. Now when we say money, we are looking at cash and currency notes and items that are normally considered as money. What is the money? What is the purpose of money insurance? For example, you are withdrawing from the bank and bringing to the office. And if on the way somebody snatches it away, so money in transit. But it is in the custody of specific persons. In marine insurance, we saw transit. But their transit is by an outside agency, a truck, a railway, ships. So these were all outside agencies. Here money is being withdrawn by authorized personnel of the organization. So money withdrawn or money collected to be deposited in the bank is insured while it is in transit. It could be many reasons. Like while traveling there's an accident and so the person is injured and the money is lost. There could be a fire while they were returning. There could be a riot and in which it is lost, so money while in transit. And also we can cover money lying on the premises during business hours. After business hours, it is a warranty that it has to be kept in the safe. So it must be stored in a safe or strong room after business hours are over. It cannot be left in a drawer or on the counter. Then the last, the fidelity insurance. When we say fidelity, we mean an employee on whom trust is placed commits a mistrust, commits a fraud, commits a misappropriation. In papers, you now see so often where an employee has run away with money or an employee has been cheating his organization with taking money and transferring to own account. So these are all mistrust cases. These are coming under a fidelity insurance policy. So what insurance is covering? Infidelity or fraudulent acts of fraud committed by employees on whom trust is placed. So these employees could be those in the accounts, those who are dealing in the daily with money, those who are in the warehouses, those day-to-day, those who have authority to sign checks and to make payments. So all of these persons can be covered. So in fidelity insurance, you can have an individual being covered by name. You can have a group of individuals, which we call a collective policy, all named. Or you can have designation based, that all these people whose designations are so-and-so to be covered. Separate amounts for each individual or a common amount over everyone. So when we look at a common figure over everyone, it is called a floater policy. So these are policies that you will come across in normal commercial. Generally, commercial organizations take all of these policies in addition to their fire and marine insurance. Engineering insurance, people find it a little expensive, but the trend now is to also insure under the engineering policies. There are many other policies. So the most common are, on retail, we'll come across package policies. So our retail, so normal small customers, householders, individuals, small shops, they may look at package policies. What is unique about this package? We have seen fire, we have seen marine, we have seen engineering, we have seen motor, we have seen PA, health, all individual policies. Now, a package policy will have all these sections related to a particular category of customers. For example, if I am looking at a home policy, what are the features? So, fire insurance for the home property, burglary insurance for the home property, few jewelry pieces that may be there, jewelry valuables would like to be insured. Cycles, bicycles may be there, we look at pedal cycle. Computers and television and music systems, we'd like to insure that. Accident, personal accident insurance to members of the family, that could be an insurance. So all of these individual policies, instead of taking individually, insurance companies have devised a package. And this type of package is available to customers from all these sections, individual sections, they can select. So what is unique about these package policies? A number of sections. The customer can select the appropriate sections that they require. Usually some of the sections will be compulsory, and invariably fire for the contents in the property are compulsory. In addition, there may be 2 or 3 more sections that the customer is required to take. If they take more than these minimum sections, they will get discounts in premium for extra sections taken. So this comprises of a package. So I've given you an example. Now we looked at home, but if we look at shops will then look at fidelity insurance. They will look at signboard insurance. They may also look at, because they have delivery services, so pedal cycle. Then they may also look at plate glass, because they have showroom where glass is fitted. So breakage of the glass is an investment loss to them. So they could look at that also being insured. So packages are devised to the respective categories. So the common retail products we saw: householders, shopkeepers, general goods shopkeepers, not high-risk goods, offices. So offices also can devise a package. Then there are 2 separate special policies devised for particular category: jewelers. Normally jewelry and jewelers insurance, the jewelry trade cannot be insured under standard policies because the problem is about valuation. So jewelers block policy is specially devised for those dealing in the jewelry trade. It was essentially started for the diamond trade, and now slowly gold and silver jewelers are also being insured, but very, very cautiously, because keeping up to prove a loss is the most important thing. How do you prove loss? You need books of accounts. So this is for the jewelers trade. Then for bankers, there's a separate policy, not covering the bank's assets, but what is placed with the bank in trust. So a bank deals with what? They receive money as deposits, they give out loans. So when they receive the money in deposit, or they receive the valuables to kept with them, if anything goes wrong, they will have to give the customer back the money. So money they are insuring while it is being stored in their premises, while it is being taken from one place to another to special safe deposit vaults, or being collected from the RBI in the form of money. Then they are giving loans for which they get security. So those security documents could be misappropriated or forged. So forgeries committed by customers as well as forgery committed by their own employees. These also are covered as a package for the businesses of the bank. You will come across many other policies. We are looking at just an overview. Aviation. So aviation insurance, when you talk of, now we look at aircraft insurances. In marine insurance, we saw hull insurance when we insured ships. Now aircraft insurance also we have hull insurance, but we call it aviation hull. What is the hull? The aircraft. So damage to the aircraft, normal damages, accidental damages that we call, not wear and tear. And war covers. So if during a war the aircraft is damaged, it is also covered. Now think of an aircraft, and what do you see? It's carrying passengers, it's carrying cargo. So it is carrying passengers and cargo. If passengers are injured while in the aircraft, there will be losses. Their claims will have to be paid. Accidental injuries will have to be paid, because passengers will tell the aviation aircraft owners or the aviation company to please compensate us because it has happened while we were in your care. So those are internal. There could be food poisoning also, because food is served. So passengers may be affected by that. So internal liabilities. Cargo has been carried. The cargo is damaged. The letters are damaged. Persons can claim for that. Or property is carried in that. So they'll recover our loss, so which we cover. So liability is there. External damages. When we look at external damages, now you enter the airport. When you're going from the airport to the aircraft, you're traveling in a bus, being taken, or while you are on the airport, some injuries take place because the facilities are not well maintained. All of these are external. General could be others also getting affected. So on an aircraft bus taking passengers causes injuries to others who are waiting there, or something falls down and injures a person, all that comes under aviation insurance. So satellite insurance also is coming under aviation. Now what we see, sending a satellite into space is an expensive proposition. You all know there are misses. Sometimes we are successful, but often there are misses. So there is a pre-launch, the cost involved in preparing the satellite, so construction of the satellite. Then we have, after it is constructed, it is taken to the launch pad from where it has to be sent out. So during launching, things could go wrong. Once it is in orbit, it has a lifespan while it will be traveling around the earth or wherever it has been sent to. If before the time it is damaged and it doesn't give us the value that we had thought of, that's a liability. So there is a loss. Liabilities also occur, because while it is launching or during the course of pre-launch, if some damages, explosions or others, and people in the surrounding areas are injured, that's a loss. Ground risk. Once a satellite goes out into space, there are people monitoring on the ground its movement and getting all the data. So those ground supports are also insured. The insurance is available. As of today, satellites are mostly sent in space by governments. So governments don't see the need for insurance. But because of the increased cost, we in India and internationally, most companies have started taking insurance. ISRO takes regular insurance for satellites. So why? Because it's a huge cost, losses take place, somebody will be liable. So this briefly was some of the policies we have seen in miscellaneous. Now here is a policy called oil and energy. In fact, oil and energy insurance normally comes in India under marine hull, because we are looking at liability, oil and energy risk of setting up a exploration for oil offshore, in riverbeds or offshore. You have heard of Bombay High. So offshore sites or in water sites where we are now drilling for oil. There are lots of costs involved. So what is a blowout? While drilling for oil, or after oil has been found, the oil also has an element of gas. So that because of the gas or some reason, that gas could blow up and that entire oil could be set on fire. So blowouts. After a blowout, it causes pollution, it causes a lot of mess, because all the equipments that have been sent into that well, it is more like a bore well where equipments are sent down. So all those equipments are thrown out and the damage has to be cleaned up. The surrounding waters and debris has to be removed. All that is part of cleaning up. there's pollution liability. There may be requirement of re-drilling another site so that we can cap it or stop the blowout. Then we have to rescue all those people who are on the site away from it and all materials, so evacuation costs. All of these come under what is known as the Energy Explosion and Development Clause of the Oil and Energy Policy. What we ensure? The construction of the platform, which is called the Mobile Offshore Drilling Unit. So the platform is installed with all the equipments that would be necessary while it is being constructed, and then after it is ready for the normal operations with all the pipes that are attached, from which oil will be taken and stored in tankers and sent wherever they have to be for processing or refining. So this briefly was our technical subject of engineering and other insurances. With this, we have seen the entire purview of all products in general insurance. We have given an overview.